Hi, this is Gina Beall, a member of Savant's Investment Committee and Research Team, here with a review of the markets during the fourth quarter and full year of 2014. The fourth quarter was a continuation of the same trend we've seen all year. The U.S. stock market was up, and international stock markets were down. Similarly, global REITs continued their strong move upward. Bonds around the world produced positive returns in aggregate, with especially strong returns coming from international bonds. The final quarter of the year began in October, with gold falling to a 4-year low and mortgage rates taking another dip down. The global stock market, shown by the line graph, gained strength later in October, and just after month end, the Republicans took control of the Senate and retained control of the House in the U.S. midterm elections. Markets peaked at the end of November, just as oil prices hit a 5-year low. Despite the sell-off in markets in early December, consumer sentiment in the U.S. climbed to its highest point in 8 years, and the Dow finished its longest annual winning streak since 1999. Most of us already know that the U.S. stock market was the bright spot in equity markets for the fourth quarter and year. While small caps beat large caps in the fourth quarter, large cap stocks were the clear leader for the full year, up 13.7%. Value stocks underperformed growth stocks among both the large and small segments. Looking back over the past 5 years, returns have been very strong and in the double-digit range. International developed markets, which include countries such as Germany and France, experienced negative returns for the quarter and year. Within those markets, small caps slightly outperformed large caps. The main reason for the negative returns this year is that the U.S. dollar unexpectedly appreciated considerably, which has a negative effect on returns for U.S. investors. Developed international stocks make up about 40% of the total world market cap today. Continuing on the world market view, when 10% emerging markets are added to the pie chart, that means 50% of the world markets today consist of international companies, and they are an important part of the investment opportunity set today. In terms of returns, emerging markets were similar to the developed markets in that returns were negative for the quarter and the year, mainly the result of the strong U.S. dollar. In other areas of emerging markets, such as small caps and frontier markets, which are even less developed, performance was also negative. Next, let's look at bonds. I like the saying, it's not your grandmother's bond market anymore. The bond market today is made up of many types of bonds in many countries. Diversifying across many types of bonds can provide benefits such as additional return and lower volatility. This was the case in the fourth quarter and full year of 2014, as international bonds produced strong returns. Who would have thought bonds would return nearly 10% in 2014? One of the other big surprises this year was the interest rates across the U.S. fixed income markets generally declined, resulting in positive returns from U.S. intermediate-term bonds. Another area of the market, inflation-protected bonds, also called TIPS, were flat for the quarter but returned 3.6% for the year. In the alternative asset classes, global REITs surpassed the broad equity markets for the quarter and year. On the flip side, commodities were broadly negative for the quarter and year. One last surprise of 2014 was the large drop in oil prices. For commodity returns, energy was the major cause of the decline as crude oil and natural gas returned negative 41% and negative 33% respectively. Conversely, wheat was the best performer with a gain of 22%. Putting the asset class returns together, the portfolios on this slide illustrate the hypothetical performance of different global stock and bond mixes of indexes. There was not a large differential this quarter across the different allocations. You can see that the hypothetical investor with 50% stocks and 50% bonds would have earned about 1.3%, while a portfolio of 100% stocks earned 2.1%. To sum up, 2014 was a good year. It wasn't as good as 2013 in terms of return, but diversified portfolios consisting of stocks and bonds had positive returns. I will leave you with a few thoughts to keep in mind. Market timing is hard. It is dangerous for long-term investors to turn paper losses into real ones and then potentially miss out on a recovery in a specific asset class. Never forget the power of diversification. There is good reason to have a mix of stocks and bonds, and within those asset classes to diversify even further by country and security type. When one is up, another might be down. Discipline is rewarded. Through discipline, diversification has time to work and reward investors. Look at the evidence. This quilt chart illustrates that the shift in market leadership is always changing. So while U.S. large cap stocks, the dark blue squares, have been near the top the past 2 years, you might recall that for much of the 2000s, international large cap stocks beat U.S. large caps, and that decade was referred to as the lost decade for U.S. stocks. The point is that no asset class has repeated as the top performer in back-to-back years as shown in this chart, and the tide can change at any time without warning. That wraps up 2014. For our market outlook, please read our upcoming fourth quarter newsletter on our website. Thanks for listening.